Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week here for May 12th, 2022. Got a lot to cover today. We're going to be focusing primarily to begin with on those row crops, taking a look at the world ending stocks, global balance sheets, and everything that came out in our WASDE report today. It kind of felt like that report, I don't want to say was known by the market, but boy, we started to move before it. Saw a little bit of news whipsaw during, and then following through on it. I think the market generally did what I was kind of expecting it to, and settling the day with some strength, and certainly leaving us, I think, going into the end of this week, questioning what the trend could end up doing. So without further ado, let's just hop right into these WASDE numbers, beginning here with our world ending stocks. This was, in my opinion, the big number on the report that we were all looking for. This was the number where we got to see if the USDA started to, acknowledge some of the drama that's going on in the Eastern Europe and in the Black Sea region, the Russian-Ukrainian conflict. We needed to really see how that's going to affect that wheat and corn production here. And sure enough, today we really did see, the USDA account for that in their numbers. Overall, that world ending stocks number here for corn, 296.91. That was, a drop of, almost 10 million metric tons off of the previous estimates and what have you. You can see here from April at 305.46. We are a little lower, 2 million metric tons lower than that April estimate, and on the low end of analyst expectations here, even for our old crop ending stocks number. That new crop number, though, dropping well below 300 million metric tons. Certainly the big reason I think we saw December corn leading the way today in the new crop rally that we saw, pretty much dictating price action for the charts. And this is what it comes down to right here. These new crop world ending estimates, those were the driving factor, in my opinion, here today. All right, soybeans. This is a shockingly low, in my opinion, world ending stock number for old crop beans. It's not that much lower than the USDA April report, but generally speaking, the trade, if you can see here, the trade was betting on pretty much no change to that number, given that we've really identified what kind of production we're seeing. Or certainly we know how much is left over, and we know exactly where those export numbers will gobble that number up to. It's a pretty stable number from that perspective. We're not expecting that to drop too much more unless buyers and export partners start to come in and really take a chew at it. But I mean, 88.98 million metric tons on hand globally, still a very low number, all things considered. Jumps up a little bit here next year, but right in line in the middle of analyst expectations there. Great. Wheat, obviously lower than the high end of our range, kind of in a push here on that April number for the world ending stocks number, but to be somewhat expected, because again, wheat production this year is, it's at a different pace, a different style, and certainly what we're seeing, what might be offset for one country in the Ukraine could be being offset in others, like India, for example. Don't have time to get into all that, but let's get into our U.S. Ending stock numbers, and then we'll get into our production here in just a sec. And of course, let's round out South America. This is quick. Not much to speak of here. Little bit softer there on that Argentinian bean number, but generally speaking, not much change in South America. This, though, will this next year, next year's crop number will certainly get interesting. I think for corn more than anything, depending on how fertilizer prices maintain through this year. So I actually think we are way high on this number here for the Brazilian and Argentinian corn production next year. And that's just assuming status quo with what we're seeing in fertilizer prices globally. If we stay with current fertilizer or the current, input costs for these acres into next year, I doubt we're going to see, obviously, I think we'll see much heavier bean acreage than corn. And certainly that second crop corn, I think we could see that would absolutely decimate production here from South America for next year. All right, production numbers for the U.S. The drop in corn yield, again, another reason why I think corn was the show of strength and certainly leading the market somewhat here today. Dropping our production number, obviously, you take a look at 177 bushels an acre over our acreage. Yeah, okay, we come down, shave off 4. I mean, you can see here, shave off 4 bushels an acre on average, and you're going to drop almost 1 billion bushels in total production. That's something to think about here. So for every, 3 to 4 bushels an acre, in terms of what production we'll lose with our current acreage assessments. Pretty much a push there on that soybean production number, a little higher given obviously additional acres if our yield is not changing. But not much to be said there for our new crop numbers. And U.S. wheat production, this was another place where the market, generally speaking, I think might have been a little disappointed, but I think it was arguably a push against a lot of what we were expecting. While we were higher on the winter wheat expectations here, we were slightly lower on a soft red and hard red winter wheat. So all in all, across the entire wheat spectrum, it pretty much was a push against our trade. They're within 50 million metric tons or 50 million bushels. That's just a few export numbers, a few weeks of exports to completely reshuffle that around and change that. I want to give a special thanks and, of course, credit where credit's due on all of these. These are all these infographics here are all from Karen Braun, a fantastic Reuters analyst who puts a ton of work, a friend of ours and a friend of the industry as well, putting out all this good work. So all of these have been from her. Be sure to give her some likes and follows there. You got her Twitter handle down here, at KANNBWX on Twitter. Special thanks to Karen for all of those. Well, that wraps up kind of the WASDE report, right? Not much to sink our teeth into. Things were generally within a standard deviation of what we would expect on everything. It was good to see, and I think the market was ready to see the USDA say something about Ukrainian acreage and the Russian issue that we're seeing and how it affects corn and what have you. So let's just jump right into it today. Where do we want to begin? I kind of want to take a look into, let's just start with corn. And let's start with December corn. I'm not going to break down the technicals on the small time frame for December corn. We're just going to stick with this daily chart. And then mainly because I think we're coming up to like a contract high, and that has me fearful and kind of ready for some kind of pullback at some point. Anytime we make a contract high in corn, I immediately put on my get ready for that 30-40 cent dip. It doesn't always come right away, but give it a day or two. All these new highs, it's like right afterwards you get one. This was the most prolonged, prolific run that we had in corn, but even every single day was a little choppy inside. That rally through April we had through December corn, and really this rally, if we go back and we look at the charts in April corn, was really a lot of bear spreading when you get down to it. It was building that carry back into the market, getting December corn well above $6 or $7, right, and then now, the race towards parity with old crop corn seems to be underway. We have unwound that oversold condition we had in corn from the end of April, early May, all the way through pretty much yesterday. We were oversold in that dip. The 18-day moving average has been the number that we've been fighting around. The market held it as support on a first pullback, broke through it. Now we've come back above it. Okay, that's kind of what we do with the 18-day moving average sometimes. 55-day moving average down around 688, 100-day moving average down around 634, and 580 for that 200-day. So long ways down. This congestion zone around 660 seems like we're just going to stay above 7 and kind of away from it. We got trend lines against the lows that come in around that 55-day moving average. I mean, this is a bull trend until it's not. It's really hard to start picking a top on December corn given the markets we have. But, another push higher. Okay, does this market take us towards $8 and then we see a pullback? Okay, now we're starting to talk about, potential swings. But I wouldn't be here betting against December corn right now, mainly because this looks like the third time up to test potentially break out of 750 and our old contract high. So we got nothing but air above. Kind of seems like December corn is really wanting to get up for a test of $8 and at the very least. And of course, we'll start to consider this a little oversold and maybe looking for top once we're overbought in this daily stochastic. Switching over to July, because I do want to then break down the short time frame here for July in a moment and what some of the technicals are doing. Beautiful trend line drawn from February's lows through March, February, end of February, early March low, drawn through that March, end of March low. We kissed that level here at 767, a beautiful trend line support, touching yet again. This is also a test back down into this inflection zone. The old highs here at 740 to 760, the area that it took us a month and a half to chew through, that we finally broke through and have now pulled back to test the support. We got a bounce off this 2 days ago. And now, we tested back up to that 18-day moving average. My concern here for new crop, or for, I'm sorry, our near-term corn, not new crop, the other end, near-term corn, is that we have hit that 18-day moving average and we didn't push above. That's something that we could easily fix tomorrow with, a continued rally back above $8 here for July corn. And note, we are just unwinding that oversold condition as well here. 100-day moving average down around 689, and the 200-day down around at 626, with that 55-day at 750. It's a bull market. We're channeling higher. We're holding trendline support. And for all intents and purposes, a push above $8, in my opinion, will confirm a swing up to new contract highs. Now, likely, the way we've been trading the last 24 hours, I would expect maybe December to continue that, maybe through the end of the week, and potentially some of the weight on the July shoulders right now is the fact that we have June options going off the board next Friday. June options going off the board next Friday, though, for all of those that know how much I like short-term options strategies to take, spend pennies to maybe make dollars in markets where there's a high probability of the market moving around. There's definitely, I think, something to be said for, between now and next Friday, I think we'll, be somewhere on this corn. I think we'll be above, 820 or below 760 on July corn. And we'll take a look at some of that here in just a minute. Before we do, though, let's hop into our 4-hour time frame here. Go break down some of the smaller time frame, the technicals we've seen. Okay, old channel broke. We got that gap. We gapped down. We came up, filled it. We headed lower. This, to me, in terms of a corrective structure, if you had to, say, hey, Dan, what does this look like? This could be the A, B, C of some kind of expanding flat. This could also have been 3 waves down, A, and then A, B, C, D, E in a triangle before it burst lower. Anyway, we held the 770 supportive trend line. We're starting to bounce up off the lows, regardless of what kind of fibs you draw anywhere else. We've got a rally that began off the 768 low to an $8 high right now. We draw a fib from the 824's highs to lows here. 50% short off the high, has tested, traded, and gotten a reaction here at 796. Kind of also a technical failure to break above $8. And today's settlement and close just minorly above yesterday's high high at 790 and a half. It is about as minimally bullish as I could get, in terms of that close, but it is a positive day with higher highs and higher lows for two days running off of kind of a solid reversal or inside day reversal structure that we saw. In other words, on May the 9th, that was Monday, we had that inside price action against Friday's trading range. And then Tuesday, we confirmed it. Okay, turnaround Tuesday, blah, blah, blah. We go higher. Or I guess that was Monday, Tuesday, and then, this is Wednesday, Thursday. So the turnaround Tuesday kind of happened into the Wednesday night. I hate that term, but it rhymes, so we love it. Point being is we've traded now back up to the 50% short. Is that a reason I would become a seller here? No, but the technical reaction off that short is certainly, I think, a reason why technical trend traders might have swapped over to the December, because the December contract really had a prolonged trend the last couple of days, and if anything, new crop has more of a fundamentally bullish cycle going on in terms of the news and everything else, while old crop corn is just doing what old crop corn is going to do, and certainly be threatened by the large amount of equity flow in and out of these markets, right? Commercials are trading December corn, right? You guys, hedgers, people who are involved in agriculture are trading December corn. The speculators are all in July still, right? For the most part. I mean, that's a generalization, but it's safe to assume if those that are speculating pure spec have no attachment to the agriculture industry at all, right? Hedge funds, whatever, they're probably trading July corn. So there's going to be much more of a two-sided trade there than you'll find in December, which is being very much driven by fundamentals at this time. Okay, so that's my 2 cents as to why and how what we're seeing. That might mean that the 3 cent update or 2.5 cent update, 3 cent update we have in July corn might be low hanging fruit, because we will expect that to go further faster in the inverted market conditions we have. But we've also seen a very big unwinding of our calendar spreads. Something that I'll just touch on very briefly here and then get back into our others, because I don't want to, this isn't a spread day, but we are bear spreading like none other these last few days. While we've been bullish in the outright futures, we've had 3-4 days of bear spreading in a green market. It's very strange, but when you consider the late planting, the questions about South American production for next year with fertilizer costs and everything, it kind of makes sense as to why we're building in risk premium and carry into that December contract right now, more so than July, because July arguably at these prices might be having some demand destruction with the lack of exports and high prices, right? Nobody wants to buy July corn right now, but if we can lock in December, we might be encouraged to do so. Anyway, these spreads have really unwound quite a bit. We are in a large trading range between, this 30 cent range right now, between 70 cents over and 40 cents over. A break below, though, this 40 cent over area, and certainly a break below this prior month here at 30 cents over. That's a big figure to me, that, below 30 cents over in this type of environment for the July D22 corn spread, that could result in a move and, down to test the contract low at 13.5 cents over, or even down to parity in this type of environment. And if that were the case, this would also, interestingly, this might be, there might be low hanging fruit there, but again, I just wanted to point out the fact that there's very much, there's a spread trade going on and an outright trade going on, and they're not in sync right now. And that's kind of okay, given the only reason we're okay with that is because of the dynamic we see with the late plant and all the things that can really affect new crop more than the old crop, right? And old crop just has exports right now. And I guess ethanol crush too, which has been awesome, but that's going to be, ethanol crush and certainly meal, and the bean crush too. Corn and bean, those are very known, almost linear numbers that we know exactly what the trend line will be for and what production will be. All right, so similar bear spreading here in that July Nove bean. But I will admit, this is looking a little bit more like we're finding the low end, or an area to start bull spreading in the July Nove bean than we are in corn. And that's mainly because we don't have as much pressure on the late plant right now in that new crop. Fertilizer and input costs are not necessarily the issue for our for new crop, so that keeps a little bit of weight on the shoulders of new crop, knowing that there's a lot that can still happen, including additional acreage, right, to soybeans that could drive that lower. So I don't see, this has been a meltdown, not a fire sale like we're seeing, or true reversal in the carry trade that we've been seeing. This is a market that, to me, is maybe finding a bottom, whereas our December, our old crop, new crop corn spread could be telling us something a little bit more fundamental about what to expect from new crop. So taking that into consideration here, July Nove beans looks a lot more corrective to the downside. I would be more inclined to be a bull spreader in that market than I would in the July D's corn. But it's all worth pointing out to everybody that, hey, We look at spreads with a fundamental perspective for a reason, and look at that. They're kind of behaving that way for us today. So to wrap up December corn here, if this 50% trade, we want to see it push above $8 and certainly up to 803 to 804. That would take out the idea that there's a big, there's some technical speculative hedge fund selling pressure that wants to drive this market lower, and we'll probably start the short squeeze higher. 50% retracement from our latest swing low to high here. We didn't quite get down to that area, we're arguably holding a same anchor new high here, drawn from this 707 high to new highs. That's the 50% around 766. That is kind of holding. And so the next swing higher, I don't think it stops at 824. I think, we have projected upside towards 852. And that is also, I think, again, if we go to 852 in July corn, well, that should arguably drag December corn at, a 30 to 40 cent difference between the two up to $8. So everything kind of fits there. And we'll see what happens. Today on the short time frame, going down to a 50-minute chart here for the corn, full 50% pullback from the low to the high, never traded on the way up, if you see that, which is why I kind of suspect that we'll go up to 805 before that level does. And if we do, then I'm drawing from there to there, and I'm a buyer in a dip if it happens. Meantime, in the meanwhile, for that to, really, I think, in my opinion, for that to continue, you're going to need to see this trend line from lows of today, or excuse me, well, yeah, it is lows of today through lows of yesterday through the low that began this entire rally. We need to see that trend line hold. In the short term, if we break below 790 in the overnight, below 787, we're going to be retesting 782. It doesn't mean a 50% from of the swing can't hold, but the short traded first. And I'd be concerned that maybe July corn needs to go a little bit lower, and 750 and below. Certainly can't rule out a move down there, but then you're breaking other trend lines. And of course, at that point, we would have to kind of consider 512 low, swing low to the 824 high. The next area I'm really, really interested in, and a bigger breakdown would be a test down to 675 to 623. But if we go down there for July corn, do we have enough time to recover and come back? Maybe not. But you know what? That's why we'd be maybe looking at December corn at that point for a buyer. But got to call out the full 50% of the entire thing that, hey, bullish above, bearish below right now, this 770 trend line. We'll see what happens. This market could be setting up for more sideways. There's a lot that could be going on, but we just don't know yet. July soybeans, 3 days now of higher highs and higher lows, a little miniature reversal happening off of the low end of the range that we have been in. That $15.60 to $16 threshold is underway, or has been, the supportive area on the chart. I would look at this as just a big range trying to work itself out. We certainly have oh man, I should just draw another one. There we go. All right, big old range working itself out. All of our moving averages are just being dragged up at this point. 1563 100-day moving average is now going to be the level that we'll talk about if we get down there. But more importantly, above us, the 55 moving day average at 1646 and the 18-day moving average at 1656. If we're a reversion to the mean trader, which means that, if we're trading daily momentum and we're expecting markets to revert to the mean, in other words, back to their average price, in this case, you'd be looking for it to revert back towards that area where those two moving averages are. And on this hook of coming out of oversold conditions on the RSI is usually a good indication for it. So today's close, effectively right up there, trying to close above yesterday's high, green day. First day here with a close and a settlement that takes this RSI back out of oversold conditions. with moving averages above, to me, is a green light to the technical momentum swing traders that look for, reversion to the mean type strategies. So that's a buy signal to me for this market to go higher. Of course, we're using these lows here that we've established at 1578. Certainly I think the low of today at 1590 is an area that makes sense to manage risk with any kind of long side at this point for a move back up to at least that area, and honestly back probably towards the high end of the range as high as $17. I would expect that to probably occur here over the next week or so. Very similar range playing out in the November contract there, but you can see here already with a close back above that 55-day moving average at 1480, just more bullish. I mean, just the pullback didn't even get back down to test those early spring lows, and we're already back up to testing trendline resistance and back towards the moving averages for the daily chart for beans. So looks very good, all intents and for all intents and purposes. The 4-hour chart here for soybeans, again, we're that big old range playing out, trendline resistance that we broke through in the near term. The last couple of days down has broken. We're holding a bit of a trend line against the lows, and this kind of expanding nesting structure, which to me does signal maybe a technical reversal happening off the lows of this chart. The problem I have right now with soybeans is that we are still in a technical, downtrend. The first in the series of the shorts off that high held here, but this is good because this technical downtrend I'm about to expose, if it breaks, it's a really good indicator that the bears really are done. First one, right, was a 50% short at 1796. It took us down to 1638. Next in the series, drawn from the entry highs around 1705 down to the new lows at 1622. 1660, 50% shorts held, and down to the next in the series around 1601, targets filled. Next in the series, from 1667, that high, down to the new low, today's new spike rally was right up into that 50% level. So for both the 4-hour charts, for both corn or 15-minute charts, whichever way you want to look at it, the intraday chart for corn and beans in the July contract both have technical selling pressure and technical sells having gone on. The corn very easily, right, or as we looked at there, 50% short off the high that we formed, and the beans 50% in the series of shorts. Well, that to me just suggests that if I'm not already long this market, this trend line against the highs, which is one way of defining this downtrend that we've seen in the market, as well as this next in the series short here at 1622, we invalidate either or both of those levels, which interestingly enough, both occur at the highs of today, basically, where that 61.8 line of the other trend, as well as the trend line break, would occur. So if we have a break, in the overnight session above today's high, I see no reason why that isn't a short covering rally back towards the 660 or prior highs here, or even back towards 688. And at that time you got to be thinking about the market at least wanting to get back to 50% of this entire decline at 1656. So and all, when it all said and done, you're coming off the low end of a range too that could probably trade back up towards $17. So more or less expecting that now after today's price action, and certainly while we stay above 1590 in this market, I think we are setting up to put some pressure on. But that all happens again with a confirmation and a little bit the breakthrough today's high for both corn and beans. I think you can see on a chart now, the opposing or the short side's opinion, how they're interacting with the market, and some of the thresholds that might push them beyond their limits. For example, a move above today's high after that news and everything else would be a good reason to get out of shorts if you're not already, or you are short or what have you too. Now, all that being said, if we do break down below 1600 again and below 1590, arguably this ends up becoming a very type of market that you're going to want to be short for. But for right now, the ball's in the bull's court. There's lines in the sand where I think they can resume and continue this uptrend with, and if they don't, there's certainly much bigger levels and an unwinding of the rally of the recent price action we've seen that could occur. All right, so Now on to the real talk of the town today, wheat. Wheat closing up over 60 cents in all three of their major contracts. Chicago wheat closing up 65 and three quarters. KC up 69 and a half, with the Minneapolis spring wheat pushing above $13 again here today, closing up 6 cents. New contract highs, overbought conditions, all that kind of good stuff. The last time, spring wheat was doing this, I think we all ran and was limit up and did all this good stuff. So we'll see what happens, continuing forward there for that spring wheat. Keep in mind here, 75 cents here for the spring wheat is daily limit. KC at 75 and Chicago at 70 with expands to 105. Might as well give you, July here. Soybeans again, 115 daily, $1.15 daily limit, expands to $1.75. And the corn is a 50-cent limit, expands to 75 currently. Okay, so everyone's aware of how big and what can happen. At least that's been covered. All right, so Chicago wheat now finally pushing and breaking out to the upside and above this 1150 area that we had been below here for the last several weeks. Okay, looks pretty constructive now. Again, so long as we don't just feeder out and sell off from this top altogether. We held the 55-day moving average there. We're back above the 18-day moving average. So, today's low at $11. So long as we remain above that, we're probably in a swing towards 13 or something, but not a huge wheat trader just because of days exactly like today. I don't know how you predict today was going to be this day when, hey, any day in the last week, in my opinion, could have been it. Obviously, we had WASDE, yeah, but you know what I mean. When I say that. KC Hard Red Winter breaking out new contract high here today above 1270. We're really starting to see the protein premium build here. The Chicago wheat is just going to get left in the dirt for KC for these winter wheat contracts, in my opinion. And that's a direct reflection of the international market at this time. The demand is for that higher, bread making protein globally anyway. And that's also the wheat that's really in question with weather markets right now, right? That we're not seeing exactly the best conditions playing out. And I don't know what had to get out of the way for wheat to finally break out like this. It's been arguably the big pullback we saw in these markets was, I think, one that we all were kind of like, why is wheat even pulling back? But markets got to do what they got to do to continue a trend higher. But I would say if you are short wheat at this point, do what you can to get out. Because this does not look like a market or a market you want to pick a top in. I'm actually shocked we didn't have a limit move today, a limit up move, given how far we came. We were almost there. Shocked it didn't go lock limit myself. Do want to touch on the dollar real quick because again, it's just been an insatiable rally here. We're back above 104, and a pullback in the dollar, is probably warranted, but we are up to the high end of the range that we've been in for the last 10 years. So, it's hard to think the dollar is going to get dramatically stronger here, given how far we've come, right? Currencies will unwind faster than you can blink. So the second this thing wants to top, it's got every ability to. But I have to call to your attention here, on the daily time frame. Of course, it all gets messed up on here. Here we go. We're not even overbought yet. So, we probably still have higher to go for that dollar. It's been fascinating to watch the dollar rally alongside commodity space now. And that's in a direct reflection of that. I mean, that's basically the world and the global market saying Fed hiking interest rates is just not enough. Because, the dollar is going to go up in a Fed interest rate rising environment. It's just what they do. The factor that will diminish the dollar, and what I think the Dixie in general is waiting for, it's waiting for everybody else to start raising rates. Bank of Japan, Bank of America, World Bank of, Australia, everybody else needs to start. The British, everybody, ECB, everybody needs to start raising interest rates to combat inflation. It can't just be the U.S. Federal Reserve. Otherwise, you're going to continue to see a flight to quality here into U.S. dollars. And honestly, the flight to quality into U.S. dollars will only precipitate inflation more. And I'll give a high five to anybody who can give me the answer. But the answer is because now the purchasing power for the dollar is more. So now we can go out and spend more dollars on commodities and buy more, which ends up just driving more inflation at the end of the day. Because the dollar rally we're seeing is a little fictitious in a sense that it is simply an unwinding of a carry trade. It is money from capital markets rushing to US dollars in a flight to quality and safety, and to maybe make some yield on now the high interest rates, or higher interest rates, but very high interest rates relative to the ECB, the British, not Australia, but certainly Japan. If you just look at the value of the dollar versus the yen recently, that says it all. And it's going to take some time to unwind that against current trades currencies like the yen, because there's been 40 years of buildup of potential energy that is starting to unwind now. So this rally in the dollar is more depreciation of the yen, in my opinion, and the euro currency than it is actual US dollar value going up, because when we compare the dollar to other things like baskets of commodities or anything else that isn't another fiat currency, the dollar is not faring too well, with the exception of against like cryptos over the last few weeks. Well, cryptos and those, another asset class that it came up to combat the dollar, right? Cryptocurrencies, those have been in a bear and projected bear market, and probably will remain in one just because of the deleveraging that we're witnessing in that environment, right? Well, that happens in all markets, and our stock market is also not immune to that type of price action. And hey, that's what we're seeing in the S&P recently too. All right, so I wanted to round out today by bringing in some hogs and feeder cattle talk, and live cattle. Our June live cattle, I don't care about the June right now. Let's bring up our August. We got to move forward into the August here. August feeder or August live cattle leaving a huge open gap around 140. I see this 132 to 141 area. I think this is just a giant range, personally. It's a 50% retracement, basically. They're down to the 6 to 8 lines, right, of our kind of stair-stepping, 2 steps forward, 1 step back, 2 steps forward, 1 step back. Well, if you're an Elliott waiver or a Gann studier or pretty much any kind of corrective structure, this A, B, C is about, this is a beautiful, beautiful daily structure of a flat. Which to me suggests that, hey, so long as we basically stay below, or I'm sorry, above, this kind of 132 to 130 area, I'll give it down to 130. As long as we're right above this area, I think we are potentially going to find a bottom here. We are oversold now in many conditions. Today's price action was a pretty good. It was one of those days where they kind of went down and said, gotcha, hit the stops that anybody, had below 3-month lows, and then, close back up inside, up inside the prior month's range. Tomorrow, if we, gap lower and head lower and a lot of big weakness, it could be, break the back, or the idea of this on this that I'm proposing on this chart. But from lows to highs here, we can't ignore that the old trend line broke. But the market really has only, pulled back into its old levels here in this August fat cattle contract. So this gap we have up around 140 and a half, not to say I'm looking for it to fill, but I wouldn't be surprised if it filled. And certainly if we can, put in an encouraging one-day reversal structure off of lows or at some point here, I would be encouraged on getting long cattle for a move back up to that gap fill, without a doubt. But this is catching a falling knife as of right now. All I have for rationale for being a buyer is it's at the low end of the range we've been at for the last 3 months in a completed flat structure. That makes me a buyer in that regard, but I like to have a little more confirmation, which might mean I wait for a move back above 135 to do anything here. But c'est la vie, that is what it is. Lean hogs. Oh, June lean hogs can't find any love. We were talked about, the 50% level here that had held. It got a reaction, and our fear that this was heading up in a head and shoulders pattern the last time we looked at this chart. Well, there you go. We broke down the neckline here at 110 that we talked about. We've reversed all the way down now to 97. That head and shoulders pattern, for all intents and purposes, to me, is now completed. Could it go a little lower? Sure. But let's see how our August hoggy is doing now, because June is obviously quickly, again, similar structure there. The head and shoulders, left shoulder, right shoulder, head, neckline break somewhere right around here. Market headed lower, came back up to test his resistance, and is now traded substantially lower. We are trading down now below the 100 figure, which is where we effectively broke out from and where our indexes have been kind of teetering. So this is, a test of the breakout from the end of last year, but does not look like the type of market I would look to, catch a falling knife on. We've left multiple open gaps now on the lean hogs. We got one all the way up here around 117. We got one right here at 112, 113. And the more of these we open, the less inclined I am to think we're going to have a bottom anytime soon. But, the more you need to wait, I should say, for a bottom to form. Another run around here around 106. Our most recent one right here at 103. So that's 4 open gaps I count above us that, once a reversal starts, I think there's a long way that our August hog can climb. I'll definitely be looking to be a buyer at some point, but right now, we're oversold conditions. Certainly the market has been or arguably has just re-entered oversold conditions from what I can see. So we'll have to, be very mindful of that. And to round out the day here for us, let's take a look at the feeder cattle real quick. Feeders being the leaders and had some good success watching this market the last few weeks, but arguably still, in this channel lower. The August feeder cattle were coming in on that old contract low, something to be, I think, very, very mindful of here, going forward. We take a look at the daily continuation chart of an August feeder cattle. We should probably look at this on the fats too here in a second if time willing. Down into that oversold condition. This is on a continuation chart, keep in mind, so it's a little different. But, this 160 figure is the next area I'm really interested in to the downside, mainly because that was just inner contract roll, the reason why we kind of gapped up there. But it's the old highs that, the market through 2019 through 2020 kind of couldn't break out from. So this pullback for the feeders just feels like a move down to that area. But it's certainly, a downtrend here until it's not. We came back up. We tested our 100-day and our 55-day moving average there. We're below that 200-day moving average and 172.87 with the 18-day moving average on our short time frame now. So we'll see what happens there. Going to just the daily chart, however. Oversold in the stochastic now, push below our level. 18-day moving average, again, 172.87. So we're down 3-4 days into this new low. And if you notice here, there's a little buy signal that popped off here on this chart. It's a little candle reversal signal just saying, hey, your stochastics and whatever are starting to hit thresholds that have a high probability of being augmenting a reversal. You can see one here at this top with that overbought condition. But interesting, this is the first buy little reversal potential signal I've seen actually in some time. But needless to say, clear downtrend. The market very well could come back down to test its contract low or push into the contract low before getting a bounce, and that's into 166. So don't be surprised, if into tonight or into tomorrow we see that gap lower. But maybe that's the capitulation this market needs, because on the August contract itself, we've never been below 166.07 half. And I think that theory is about to get tested here into tomorrow's open. So new contract low, we gap lower, we reverse the day and end up trading higher off that low. That's a perfect island reversal into this type of environment that I'd be looking for. So hey, for me and my advice, I'm looking for that to kind of happen before stepping in and catching the falling knife. But the market has, I think, the psychological dynamic to make it happen. So, all right. Well, that pretty much wraps up everything I was planning on talking about. Real quick, I guess, while I've got the chart here, crude oil, very much sideways in a range above 110. I think much like we're looking at the soybeans above 1630 would accelerate things higher. So, but crude oil's just been caught in a range, but stabilizing above $100 a barrel is pretty much good for no one but crude refiner or crude producers. And to me suggests that inflation is here to stay and not at all looking to to sell off here at this point. We do break below 100 dollars a barrel. Next area, $80 a barrel could be the next really big area to the downside, but more concerned if we break above 110, 116, next area to the upside is like 150 to 160. So I don't know. I think we all have a love-hate relationship with energy, given how much it's helping our corn the price of corn right now and biofuels, but also, every time we go to the pump, it's like getting kicked in the teeth, isn't it? All right. Well, thanks for joining me, everybody. This wraps up your Strategy of the Week webinar. You can always get in touch with me over here at Zaner at 312-277-0110. Find me on Twitter, Facebook, shoot me an email. I'll include a link, here. You're looking to get an account rolling, looking to get something up and going. Costs nothing to have an account with us over here at Zaner. We're always looking to, earn your trust and work with you to show you the value, we can add to your trade plan or to your business. But with all that being said, everybody, have a great day. Have a great weekend. In case you don't hear from me tomorrow. We'll see if these trends that we kind of have begun today off the lows want to remain intact. I think tonight and into tomorrow are going to be key for those row crops. And we'll see where the market settles out into the end of the week. Because next week, going into next Friday's June option expiration, the markets are certainly going to be pushed around, wrestled with before some decisions, I think, are finally made. Have a great day, everybody. Remember, trading futures involves risk and is not suitable for all investors, and everything I talked about here today was just my own opinion, not a direct trade recommendation. Have a great day, and we'll be back with you as price action develops. Take care, everyone.